Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? I hope you're having a great day. This is our FinTips series, very short FinTips series where we just cover something new, interesting, things that we're coming across, new law changes, investment ideas, tips, tricks, hacks, you name it, we're happy to help. We're financial advisors here at Jazz Wealth, and we want to bring the type of help and advice that you get at Goldman Sachs if you have $10 million. We're bringing the same thing to those of you who are just getting started. Maybe you have $10,000 and that's all you've invested so far. That's okay. We want to give you the same help, tips, and tricks to get you up there as well. So hope you'll check us out at jazzwealth.com. The question of the day is, should you really be investing right now? We're financial advisors. I just went through the whole sales pitch thing, right? So theoretically, I should be on here saying, put money into the market. Should you? Right? I don't know. I'm getting calls left and right from people going, Dustin, I filled up my Roth IRA, I filled up my 401k, I need to invest some money. And I go, why? What did you not hit the number that you had in mind? The first thing I want all of you to do is to save for your number. And actually, let me go like this here because I forgot to put the thing up there. Let me show you real quick. I want you to save for your number because that's all you really have to do. And I know a lot of financial advisors would be out there and they'd be like, well, you should put a lot of money away. Keep putting more and more money away now. Don't stop. And you go, why? There's got to be a point at which you've saved enough money. So that's your number. I'm going to give you a quick example here, if I may. Let's say somebody is 25 years old, right? Just getting started. They're going to retire at 67, or at least that's the plan for right now. And they go, Dustin, I need $50,000 a year in tomorrow's dollars, right? But today's purchasing power, right? So we're going to use that as our example. I need $50,000. I'm expecting, I don't know, maybe $1,000 in Social Security. That's below the average there. They don't know what they may have. Maybe it'll be even some other sources of income. We're going to say a 7% return on average. We're actually going to factor in inflation as you go. That person has to invest what was that? What was the number there? $4,538. That's all they have to do, right? So $4,538, if you have a Roth IRA, you can fill that thing up, right? You could put some into 401k if there's a company match, right? $4,538, that's all you got to do. Just stop after that. Why are we trying to save so much money? That will get you to your goal. Now, if you want to put a little more in, that's fine. Maybe you'll change your goal or whatever along the way. Maybe you want to factor some health care in there. Who knows what sort of concerns you may have. But why are we trying to save $20,000 or invest $20,000 when all we need to do to get to the goal was, for this person, this example, was $4,500, right? So I want you to start with that first. Doesn't mean you can't have a higher goal or put more money away. It means that whatever you're saving for, $50,000, $60,000, $80,000, $120,000, go for that. But when you hit that goal, now let's talk about that. Now you've got extra money and you say, well, I put the $4,538 away, Dustin, but I want to invest more. Okay, for what? Right? That's like a question that trips up people a lot. And they go, I want to buy real estate. I go, okay, you want to buy real estate. Maybe you better just save your money, right? Now on our website, what we have is we have a lot of people that want to save for short-term type goals. And so what we did is if you go on our website and you click on portfolios, scroll to the bottom, you're going to see up top are the aggressive funds. Down here are the super conservative funds. What we did is we played with the funds that were between here and here. And what we took all of them and we said, all right, how can we mix these together to get a return that's just better than a high interest savings account? And currently our, what we call it a growth and income mix right now, is up over 6%, right? And that's okay because that's the only goal was just a little growth with a little income in there for people that are short-term savers. So they go, I can only get 2% at the bank. Dustin, you got me 6% for saving already. I mean, it's like May already. We just slowed all that down so we could lock in those gains for them. But if you don't want to do that, or you don't have access to something like that, or you just don't like us and you don't want to work with us, that's okay. High interest savings account, 2%, 2.5%, somewhere in there. You go, Dustin, that's not a lot of return, man. I need return. Why? Think about it for a second. The economy, I'm not going to use the word weakening, but the economy is certainly slowing, right? We're growing, but we can't grow at the same pace that we've grown. And that's a big mistake, by the way, if I could focus on that for a second. People go, oh no, the economy is in trouble, we're going to crash. No, the economy grew like this It can't do that forever. There's nothing wrong with the economy going like this and then doing one of these things, right? It's just going to slow down its growth. But in that meantime, what happens is people get really nervous. They think the markets are going to crash, right? They think the economy is going to suffer. People will pull back. We just saw it last quarter. People started to pull back thinking things were going to get weak. What if you had a bunch of cash when everybody was getting nervous? When corporations were laying off? Look at Tesla right now. Elon Musk at Tesla is now looking at every single penny that they spend. He's signing off on every 10th sheet of money that goes out. He's having the CFO sign off on every single purchase. He's a little nervous about money, right? You're seeing this with companies all over the place. So, what if you had cash? Do you need your money to grow at 6% if there's a possibility you lose some of it? Maybe not. There are times in life where cash is better than having investments where you go, well, I guess I'll wait another year, right? So consider maybe just the high interest savings. Depends on what you're trying to do there. If you have cash available, well, when the markets fall, all right, there you go. Now you can invest that cash if you want. When real estate takes a break or just cools off for a while, all right, now you got some cash. You'll have less people fighting over all the properties because they already spent all their money chasing real estate. So you'll have some cash to buy some property. If you want to invest in something else, that's okay too, right? Now I'm assuming you have your emergency fund already, right? Like you've got the savings. That's off to the side, right? You've saved up your 8 months emergency funds. You know how I say it, 6 months in the bad times, 8 months in the good times, right? Of your income, you good? Okay, so you did that. Now the extra money, save it, right? Maybe invest a little, but save most of it, because I'll tell you what, some of you have never lived through this before. When the markets get a little scary and the economy starts to maybe even just hint at a recession, one lower quarter of negative GDP, all of a sudden people go, wow, maybe we shouldn't hire anybody. Oh, maybe I won't buy those houses. Maybe I should start letting go of people. Maybe I won't produce as many little widgets as I normally did. Some of you have never lived through that, right? When that happens, all of a sudden, opportunities, right? The one that I'm most excited about is freaking Disney World. Disney World is so packed. I live an hour away. It's so packed I can't go. I can't even get a hotel room over there. I can't even go. There's just too many people because everybody's got money. So I want the economy to slow down so I can take some of my cash, go spend some money at Disney World, have some fun. All right. I'm not saying the economy is going to get weak. I'm not saying that things are going to crash. I'm saying that right now when times are super, super good, invest for retirement. Get that thing on autopilot, but the extra money you have, maybe don't chase yourself to put all the money in the market. I get questions all the time when people go, Dustin, when's the market going to fall? And I go, where were you? The market, it just fell. It fell 20+%. What were you doing, right? You see why it rallied so fast? Because everybody was waiting for that drop. It just fell. It already happened, right? So it'll happen again at some point, but when the markets start to cool off, the economy starts to cool off, I'm just saying, maybe a little cash is okay. And I know that goes against everything that I should be saying, financial advisor, invest, yada, yada, blah, blah, blah. But what's best for you? Is a little cash in the bank, maybe just growing to offset inflation, maybe that's okay for now. When opportunity comes knocking, you'll have cash. You'll stand out. Just saying. Well, I hope you enjoyed that. I'll quit ranting for now. Enjoy the rest of your day. Hey, at 5 o'clock, I'll actually talk about the stock markets. I do a complete stock market overview. We call it the closing beat. I'll show you how much I pay attention to all the investments that we watch here for our customers. I'll review the stock market, the good, the bad, and the ugly. Maybe you'll learn a thing or two. If you're interested, check us out. It's live on this channel at 5 o'clock every single market day. Enjoy the rest of your day. See you.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.